Hello guys, how are you doing? Both on Substack and on YouTube. So it's been the holidays, therefore I hope you are having, a great time with your loved ones, your family, friends, and all that, because in it's always important to have people around you. And yeah, so I hope you enjoyed your holidays. I know I have done. I haven't been in front of the screens for like 2 days, I think. So it's been nice to be, away, but it's also nice to be back and to basically follow the end of year close. You can say here we have a few days left for trading, and we will have the monthly candles closing, and I will be doing a summary of that in gold and silver, Bitcoin, the tech sector, all that good stuff, uranium, of course, platinum. Look at the monthly candles and see what this could mean for 2025. And yeah, so for this video, guys, I just want to give you a brief update on rates. Nothing, completely insanely in depth. I know there are people on YouTube that are way better than explaining this than I am. For instance, you should definitely follow the Market Sniper. He's really good at the big whole macro view, right? He's really good at explaining it way more in detail than I'm able to do here. But I just want to show you a few important trend lines on the 10-year, a little bit of explanation. And also we will look at the tens and twos inversion here. You can see down here that on the US rates, just to see what this means for us going forward. So let's look at the US 10-year. I could have used the 30-year, but I like to use the 10-year. It is the benchmark basically for rates. And I want to look at the monthly here. So we're looking way, way back, by the way. We're looking back a decade here, but I want to focus from the peak from 1980. This was the peak in the 10-year, basically hitting 16% at that point in time. That was needed in order to kill the 70s inflation run up. Uh, there you needed, this amount of high rates in order to stop inflation, meaning people at that point in time said, cool, I will rather take, roughly 20% over gold, over whatever you had at that point in time, and basically stop spending and getting a lot more trust into the system. It meant, of course, that for 10 years, equities, the big indices, the SPX and all that, they performed really, really poorly, basically doing nothing for 10 years, and adjusting for inflation, they of course did even worse, right? So the 10-year at that point in time made a very, very long-term peak. Actually, the peak looking back at like a decade or so, excuse me, a century, 100 years. Um, and from that point in time, they could lower and lower rates whenever we had a crisis, right? Meaning, if we add a trend line here from the highs from the 80s, you can see here that we are touching it ever so often. And again, here you can see that you could make it like a little bit of a rail here just to get the more recent tops as well. But you can see whenever we start to get close to that ceiling, we are getting a crisis every single time, right? We had the 90s here. We didn't come all the way there, but there were definitely a crisis in the 90s. And then again, of course, we hit it here in the 2000s with the dot-com bubble, and rates plummeted. Basically, the central bank started to, you know, inject tons of money at that point in time into the system as well. We bottomed out, and of course, rates started to creep up again like they normally do, right? Into a large wedge pattern here, bear flag, bear wedge, into the exact same rail here, double top here, back in 2006. And you know exactly what happened in 2007, 2008. That was actually the big global financial crisis where we came down heavily, and rates puked down to 2.2. And basically, from this period on, at least in Europe, we basically had 0% interest rates from the central banks, more or less, right? Kept it extremely low. This is the US 10, the US, by the way. So, but you can see here we're at 2% here, 2012, they put it down to roughly 1.4, 1.4 again, it started to creep back up. And what many people don't know is actually that in 2019, somewhere around over here, we actually had the repo crisis again. We peaked there, and a little bit later, we had the repo crisis, which is not something that you will see on mainstream media. But basically, what this means is the banks were not letting, they were, the rates that they had to borrow from each other were like 10%. So basically, the entire, internal banking lending system froze over, and they had to step in and actually um, ease, with some more easy money in order to freeze up that whole situation. And then, funnily enough, right, the banking sector is in a big crisis, and then you had 2020, right, and that is actually a very important moment for rates because it meant that rates plummeted below the 2012, 16, and then 20, by the way, the 4-year cycle here. And then it plummeted all the way down to basically zero. And this is the blow off top. Usually at end of trends, you are getting a blow off top to the upside or the downside, right? Ending the trend. This is, you can see, this is just a 40-year downtrend with a complete collapse, meaning rates are going down and bonds are blowing off to the upside. The TLT will look something like this, right? Creeping, creeping, then boom, and then getting back down again. So that is the blow off top in bonds, meaning the bond market has peaked for a very, very long time. And yeah, that was peak bond prices. And basically everyone that has invested it into bonds ever since has been still underwater. And pension funds, big, companies and all that, they at least pension funds, they have to, buy bonds in their portfolio, and they have been getting crushed. So end of trend, huge collapse here, basically going vertical. You can see here vertical, meaning completely, blowout in rates and a blow off to the upside in bonds. And you had a quick snapback back above that level, retesting it. Big inverted head and shoulders right here. If we zoom in, you can actually see it with the left pit being here, right pit there, neckline, complete collapse. Boom, that's your head, that's your shoulder. Little bit of a dribble here, as you often see. You see that tag, and then you often see a bull flag to some degree. You can see here we can go down to the weekly, and you have that little bit of a bull flag here, and then boom, rate has gone up ever since. And look what happened here back in 2022. We actually broke the 40-year rail or trend line and retesting it, and then slowly creeping higher here. Stalling, yes, for like 2 years. It has been stalling. And that is where we are now. We are now sitting at 4.6 roughly. And if we zoom in here and only look at the past 4 years, here is your blow off top to the downside. Complete puke. Neckline over here, right? Boom, there it is. So what could happen here? Multiple things. This could be, again, before I go into that, this whole thing with lower and lower rates, whenever we have a crisis, they pump into the system. That is no longer efficient, right? So, by the way, here, as mentioned, what I was about to say is that, we are seeing lower and lower rates for like 40 years, because that was the idea behind it. Whenever we have a crisis, you pump liquidity into the system and you go again, basically. But that is over. And now the system is feeling diminishing returns. And what is that? That means that the efficiency of them pumping liquidity, lowering rates and all that into the system, get less and less efficiency. So we have the 4-year here. And what could happen, there are multiple things actually. We are having this kind of little bit of a rollover where you're having marginal higher highs. So we could actually see a move down to retest the 40, 50-year trend line at 2.6. 2.6. If we zoom out here, that would be, from a technical point of view, completely by the book if we get that move. And that is probably the lowest we will go. We might dip a little bit below here, but again, pushing it below that trend line, the amount of money that they have to do to push it below there will be in the amount of liquidity that they need in order to push it below that level would be extreme, right? And if they do that, if they start to really crank it below here, the amount of inflation that you will see, remember, the efficiency of that money will not be, into real growth. That will go into a ton of inflation in commodities, in wheat, what you and I buy, because the value of your currency is getting diluted heavily. So we could see a move here down to roughly 2.2 here. But in order to do that, we need a crisis, right? So what will it be? What will be the name of the crisis if that were to happen? And they will be able to pump liquidity and have rates go down by roughly 50%. What could it be, right? Let me know in the comments below what you think. Last time over here, we had, again, 2020, what happened there. When we had this crisis, the banking crisis, the repo, all of a sudden we had a big crisis a few months later. What will it be over here, right? If that is the case, to get down to there. However, it could be that we will not go down to here, and actually we are having a teeny weeny bull flag breakout here. Remember, this is only 1 year, so this is only 1 year out of like 50. So we are actually breaking out here with a little bit of a deep retest, breaking higher. We haven't made a higher high just yet here. You can see it here, lower lows and lower highs, basically from here. So we haven't been making the big higher high just yet. And we shall see how it goes over here. But clearly, rates are extremely strong right now. And in order for this to come down to here, right, we obviously need a big false breakout, and then we will collapse down to there. But for now, rates are insanely strong. Again, rates will, over time, make higher highs and higher lows, meaning that this breakout here is a major high, obviously. We could then see the major higher low. Let's say we come down to here, and then it will start to creep up again, and then we will go higher. No question in my mind is that we are going higher and higher over time. It all depends on the route, but this whole downtrend is over. No more lower rates over time. We will see higher rates over time, with obviously pullbacks, right? Obviously. So yeah, extremely important thing that happened here in 2022, where we actually broke that 40-year trend line. So, and if we are to measure the move here from the blow-off top, we can do that. We should actually be seeing a move to, at some point in time here, that is the measured move, to 9.5%. Will it be, as I mentioned here, a move back down to here, and then we will slowly go? Or will it be from here already and just climb higher and hit it there? So interesting times for sure. Before I will let you go, very briefly here, I have the 10s and 2s. So this is the yield curve between the 10s and 2s. And I have it on log scale because it is actually very easy to spot the inversions, right? We had a big inversion in 1998, recovered quickly, and then you had the big inversion back in 2000s on inversion, and then you had the crisis a year later. Again, here you have 2007. A year later, 2008, 2007, you started to see, the global financial crisis. And also here, by the way, you have the 90s, again, with the crisis there. And this little blip here is, you can see here actually, the repo crisis in late 2019. It wasn't, they managed to patch it really quickly with some internal, lending from the central banks. Basically, they almost gave them like unlimited liquidity in order to to fix that freezing up. And then later on here, again, you had the March 2020 event. And now you can see here, as the 10-year broke its 40-year downtrend in 2022, August roughly, we started the inversion, and we have been inverting for like 2+ years, the longest inversion, going back at least 50 years here. And we are now uninverting and actually coming up to where we are probably going to stall a bit here. But this means that the energy in this inversion here, this entire area is, more than twice as much as the dot-com bubble. It is basically also more than twice from the financial crisis here, but also from the dot-com bubble, more than twice. So the crisis will be huge, in my opinion, unless it's different this time. I wouldn't count on it. But again, we have been uninverting, and you can see we are getting back up here where when you start to stall here, that's when the big hit happens, right? This is where things are going south really, really quickly, and markets will tumble. I could do an overlay on the SPX, by the way, and you will see that when we start to stall out here in the inversion, that's when you get the nasty things after the big uninversion here. Excuse me, the big inversion and then the uninversion. So funny times ahead for sure. We will see how and which direction it will take us. But one thing is certain, that rates, that's the DK one. I don't want to look at that. I want to look at the US, of course, is that rates are higher highs and higher lows for the next many years. I think we're talking the next 10 years at least. And during that period last time, at the end of it, we saw gold and silver do really, really well. So yeah, again, fixed mortgages is very important to have at the moment. You might have one more chance to get a low fixed one until we get the next big move to the upside. So, but until that moment there, and basically until March 2020, having a variable mortgage rate where you refinance every 3 years, 5 years, has been a very lucrative situation. But that is over, and if you have a variable, you will probably have to, over time, slowly but surely, pay more and more and more for that loan. So that is my take, guys, on the US 10-year. And again, Merry Christmas to you all, and yeah, have a great day, guys, as always. Cheers, guys.